Bum, 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 bum. Well, hello. We're going to be having a look at opportunity cost. Roll the intro. Hi, welcome to the channel. If you haven't been here before, my name is Langers and I am the Scruffy trader. And what I'm trying to do is kind of put trading in the real world. Maybe show you a trick or two along the way. If that sounds good, please click the little subscribe button and we'll crack on. So what are we doing today? Well, I've got a couple of little shout outs. First one to Nick. Saw you help support the coffee fund. Very gracious of you and this is great. And secondly, to Michael. Now, Michael asked a very good question. He'd heard me mention before opportunity cost in some of the other videos. I just wanted me to explain a little bit as to what opportunity cost is. Well, in trading, it's about managing your account, but also not missing out on other trades because you've maxed your account. So I'm going to try and explain it a little bit on the whiteboard and show you what my definition of opportunity cost is. Okay, so most people, when they say opportunity cost, they would look at it separately, which you can, and then also the way I look at it is I combine the two. So let me explain. So what's the opportunity? Well, opportunity comes in many forms. The first one is time. What is the opportunity time that you have? Well, you might trade, like what I do, the London session. So the first part of your opportunity is when you can trade. So you're going to be trading the London session 9 to 5, just for argument's sake. And the second part of the opportunity is the instrument that you trade. So if you're an indices trader, it would be the FTSE. So that would equal the FTSE. Simple stuff. That's your opportunity. Then you just have to sit and find your entries, etc. But what's the opportunity cost? Well, that's the cost of doing business. Now, most traders, they start with a small account, £500 say. So we'll use that as an example. £500, and you might be on £1 a pip or a point. But in order to open up that pound per point, you need to hold £340, I think it is, in your brokerage account to have a position at a pound a point. I'll show you that in a second when I go on a spreadsheet. But you're going to do pound a pip. And in order to open it up, I'm pretty certain it's 340. So that is the cost of the opportunity. Okay, so that bit's the boring bit. But what does it mean to a trader? What does it mean to me? Well, I actually combine the two together. And then it becomes opportunity cost. And basically coming down to what I could possibly lose. And I'm going to show you that in just a second. Well, first of all, I'll jump on the spreadsheet and I'll break down how many trades, etc. And then I'll show you what that cost is on a whiteboard. All right. So bear with me. Let's jump onto the computer screen. Okay, guys. So let's see if I can make a little bit sense of what I'm trying to explain. First of all, let's have a quick look at the FTSE and see how much it actually costs to open up a £1 position. I'm sure it's about £340. So just pop that on there, put an order on. £1, yeah, £341.30. So if you have a £500 account, you'll be able to trade the FTSE quite easily. Okay. In fact, you could even split your bid off in the way that I split them and have 52 50p positions. You have one close off at 10 pips. Great. Let the other one continue to run. If it reverses back, open up another one. It's being paid for. But I'll kind of explain that on the whiteboard in a second. So what else are we looking at? Well, I use calculators like this all the time. Obviously, I journal a lot. But let's just say you want £5,000 in a year, as I was alluding to. How much do I need? Well, we've worked that out. You know you need sort of pound a pip, and you can afford that. So what does a pound a pip mean to get 5,000 in a year? Well, if you're making 10 pips a trade, you would need to trade twice a day. Right? So straight away, your opportunity cost is there. But that's assuming that you are hitting it all the time. You want to be a little bit further than that. So if you're aiming for 20 pips, try and get some little bits of runners at 30, 40 pips. And those little extras make up the days that you lose. Because as good as what anybody is, you will lose. I lose all the time. You know, I'm pretty good at what I go in, but I don't get it right all the time. So the runners help offset that. So straight away, there you go. Right, you can see you need to trade twice a day to get 5,000, and I'm going to show you how you can do that on the same trade using opportunity cost. And I'll try and explain it best I can. But basically what I'm driving at is, how many times have you entered a market, it goes so far for you because you've overstretched yourself, you're trying to get 50 pips when the market will probably only go about 30. But in between that 30, it'll go 10 pips for you, go 10 pips against you, come back 14 pips, go back 10 pips against you, and then go down into target. Well, you've missed a couple of opportunity costs. So let me jump onto the whiteboard and I'll try and explain it. Yeah, I'll just try and explain it really best I can. But if you are stuck, by all means contact me and I'll try and point you in the right direction, because this is something I do quite regular. It's all part of averaging in and averaging out of trades. It's basically using money banked to open up new positions, or using money banked to pay off losses. And then at the end of the month, you might have started with a 1-to-1 risk reward. In other words, 30 stop, 30 target. And you've been carving off at 10 and 15. But across the month, because you're in and out of the market like this, you find that your risk reward is actually higher.
No way!
Okay, so let's jump on the board and we'll have a look at it. Okay, so we kind of worked out that in order to get £5,000 a year, we need to trade twice at 10 pips each. All right. But if I'm on a pound a point, as we looked at earlier on, I can only trade that once at a time because I would max out my account. So that means I am losing opportunity. But think of it this way. So you've got a standard chart. It's driving up like so. And at this point here, that line, you want to enter. Now, normal circumstances with your risk reward 2-to-1, 1-to-1, whatever, just for ease of maths, I'm going to do 1-to-1. All right, but your runner could run to whatever. So we're going to assume because a lot of people over-egg themselves and they want a 30 pip. Right? That's your target. You want 30 pips. But how many times do you enter a trade, goes for you halfway, goes back to where you've come, goes way past your entry point, then comes back, and then goes down a little bit, and then back up again? Happens all the time. So let's have a little exercise. So we're just going to assume that underneath there is 30, and we've got another target up there at 30. Okay? And you're going to do a continuation on. That's the general idea. So what we're going to do is we're going to break this section into 3 bits. Alright? So that will be 10, 20 and 30. Okay? Now we've seen the price up, you've been triggered here, but we're also going to trade up this into 3 bits. So the dotted line there. I wasn't very good at art, by the way. And a dotted line there. And again, 10, 20, 30. Alright? Now bear with me. We can only trade once. Now, a lot of the time when you are trading, and the image of the industry is you're in the market, you're out the market, you're in the market, you're out the market. It doesn't work like that. Never does. I mean, I can go in a trade, I can be in it for 30 seconds, I could be in it for 3 hours, you know, even overnight, because the market will do what it wants to do. You've got no idea what the future is, so you need to be kind of prepared for it. But what I do see is all the time, I enter, goes against me, goes for me, goes against me. Now this is where the opportunity cost comes in, because as it's going for me and against me, I'm losing opportunities. So we enter, and it goes for me to 10 pips. At that point, close off 90% of the trade. And I know you're going, what? 90? Well, you've just made £9 and you've got 10% of that trade running. Okay? The market comes back down to here. Does it all the time. You can now make a choice. You can either re-enter the market anywhere between there and there. Okay? But just for easy maths, we're going to assume you're going to enter at the exact same point at where you were before. Now you've just put your margin back into your brokerage account, which will allow you to open up a second position. Okay? So you're back in. And it goes up to there. You take out another 90%. You've now got 20% running. Okay? And you've got £18 in the bag. So you're actually over halfway to your original target. Comes back on you. And you're thinking, oh my God, worry, worry, worry. Moves back up to 20. Happy days. You're break even now. Can't lose anything. You've been paid, and a lot of educators, myself included, advocate scaling. So if you get so far, take so much off the table as you're going, this has just helped you do that. And then it continues to run up into your target. Wonderful. You've been paid, you've got a runner. You can close one off at the 30 pips and you could let the other one keep on going. Now that might have happened 2 or 3 times. So your opportunity has been given to you over and over again on a single trade, as long as it stays between that and that. So your risk's always the same. Okay. Now it works the other way as well, because if you had it wrong and it came down to there, you might take so much of your order off just so that your loss is not so bad. And then if it went back up to there, it's helped offset some of your losses as well. So it's all about managing the trade, but the main crux of the whiteboard was about the opportunity of the price bouncing backwards and forwards and the power of 10 pips. So you don't have to do it at 90%. You could say take half of it off and let it run. But the reason why I say 90%, it would put enough back into your small brokerage account to allow you to do the next trade. So I hope that kind of makes sense. The whole idea of it is it's about account building and how to build an account. And the reason being is most new traders swing for the fences. You know, they think they're going to get 50 to 80 pips per day. And the markets don't often do that. But what they do is oscillate backwards and forwards like that. And if you can catch each one of these 10 pips but leave a little bit on the table each time to a bigger target, you'll find throughout the day you put money in your account and all these little slivers adds up. Now you might end up having 3 or 4 little slivers running, which then equal a full position size, and it's all off one trade. Hope that kind of makes sense. Like I say, it's an off-the-cuff video, and it's just kind of trying to clarify a little bit as to what I mean by opportunity costs. So I suppose the moral of the story is don't max your account out so you can't take opportunities as and when they arrive later on throughout the day. Because once you're locked into a trade, you're locked in. And sitting on heat is never very good. But that is a good way to manage a trade. All right. So I hope you're all well. And as always, do what you love and the money will follow. See you all in the next one.